got to stop doing this. I'm talking about a common trap that homeowners fall in when it comes to searching for mortgage loans online. And that trap is discount points. Most of the time, a consumer doesn't realize that the advertising is laden with extra costs that are built in. And a consumer may think that they're looking at one company that has a better interest rate than another. So the purpose of this video today is to talk about what I've learned in my 23-year plus career in the mortgage industry about these mortgage companies and what they're trying to do to trick you as a consumer. So first, let's talk about mortgage discount points. Now, are they worth paying? This Forbes article is going to give us some details about what are points. Mortgage points represent a percentage of an underlying loan amount. 1 point equals 1% of the loan amount. Mortgage points are an additional upfront cost when you close on a loan, but they're also a way for borrowers to negotiate a lower interest rate for their mortgage. So, this article basically talks about points and what they can do for you as a consumer as far as getting you a lower interest rate. Sounds pretty good. And also, I thought it was kind of ironic the advertisers they choose to work with here. Look at this, all the interest rates they have points that are associated with them. Kind of proves my point. So, to move on here, looking at NerdWallet, should I buy points? If you can afford them. Well, that's not a great idea, but if you can afford them, the decision becomes whether to pay points if you're going to reach the break-even point. The concept of the break-even point is simple. When the accumulated monthly savings equals the upfront fee, you've reached the break-even point. So a break-even point would mean if you're spending several $1,000s upfront to get the lower interest rate, because you're saving X number of dollars per month, you're going to recuperate what you spent in a certain amount of time. That's the break-even point. And the pros and cons of buying down your mortgage interest rate. This is from the Mortgage Reports. It's actually a mortgage company that runs a pretty good website, but it's a source to get leads for them basically online. And it talks about pros and cons of buying points. Obviously, the pros are going to get a lower interest rate. That's good. A lower monthly payment. That's good. Possibly qualify for a larger loan amount. Could be good. And save money over the life of the loan. Probably not good because nobody keeps a loan for all that long. The cons, increased closing costs. Big con. Potential to lose money if you refinance or sell before breaking even, which you will. Depletes your savings. Potentially less money to spend on a down payment. All true. So, Dave Ramsey, what does he have to say? I'm sure he loves people paying discount points. I'll fast forward here. Should you pay discount points? It seems odd to say, but paying mortgage points to lower your interest rate could actually be a complete ripoff. For starters, it could be years before you really save any money on interest because of your mortgage points. So, like I've discussed so far in this video, mortgage companies know you're not going to keep the loan for very long, but they also know that as a consumer, you're probably searching around online and looking for the lowest interest rate you can find. So they're showing interest rates that are lower. They have a whole bunch of fees on them that you probably don't understand. The CFPB has information about this, which they're the Consumer Financial Protection Bureau. They're supposed to be the watchdogs that protects everybody out there. And they tell you, again, what are points, lender credits, which are the opposite of points. We'll get into those. And one thing I thought it was interesting, again, that they talk about here, depending on the amount of time that you're going to own the home, they are really, reiterating the fact that, paying points is probably not something that's going to make sense unless you've explored all these options. And for you, you're going to keep it for a certain amount of time. So, again, they're reiterating the same thing. Yes, they are out there. Yes, there are circumstances where someone has to pay points. For instance, if they have a really low credit score, sometimes they don't qualify for loans without points. Also, sometimes to qualify for a loan, a consumer needs a certain interest rate. and that rate might have points. So those are not everyday situations, but they do happen, and points are needed in those situations. But I'm talking to everybody else, the consumers that do have options out there, do have good credit scores, have a little wiggle room in their debt to income ratio. Chances are the advertisements that you're seeing are just to lure you in with a low interest rate. You're not going to recuperate the exorbitant cost the lender is wanting to charge you. The mortgage reports also talks about lender credits. The lender credits, to me, are the way to go for a consumer. I've personally only done refinances on my home utilizing lender credits with no closing costs, zero anything added to my loan every time I do a refinance. So every refinance I do, I get a lower interest rate. I never add 1 penny to my loan. Most consumers cannot say that. They're adding in the fees, the points, and their escrow money all into their loan every single time they refinance. So using lender credits can mean that you are putting yourself in a position to never lose out by refinancing. When you pay fees, you have to keep your loan a certain amount of time. If you refinance again, you never made your money back from the last refinance, and then chances are you're going to do it again after that. And these lenders just continually make more money off of you every single time just because you're not educated as a consumer to look behind the curtain. So I hope with this video today, this is something I'm beating into your heads, because I don't think you're stupid, but the mortgage companies out there do. As a consumer, you got to be wise to these things. Biggest name out there, Rocket Mortgage, a name everybody knows and trusts. Their website advertises all their rates with points. 2 points, 2+ points to get an interest rate that's not even that competitive. But this is very expensive. A jumbo loan has a point. Those are big loans, and they all have 1 point, $11,000 on that example. So, you have to, again, realize what this means. Most people gloss over it, but these points are very, very expensive. But Rocket's not the only one. Here's Chase. Chase doesn't show it here. They just have the APR higher than the rate. But you got to scroll down below. Rates displayed in this table include approximately 1 point. So that's, again, a factor into this. This rate looks a little higher than Rocket, right? But Rocket has 2 points. Chase has 1. Who's better? Got to do the math. But to a consumer, they go, oh, Rocket's better. It's not. Wells Fargo, another way to advertise. They have a 6.25 30-year fix they're advertising on their site today. They don't really talk about exactly what the points are here, but there's $7,000 in closing costs. So there's all these different ways that this is hidden and done this way, but there's one reason why. And I really appreciate this story that was done by a competitor. It says, why do we quote rates with points when we dislike points? I've worked in call centers where I am sitting next to guys that are, or girls that are selling on the phone, and they always quote rates that are really low, but they had a lot of fees on them. And in the conversations would oftentimes not really talk about those things because the consumer doesn't ask the questions. They'll find out later. They got a lower rate. They heard a lower rate than another competitor said, and then they got a client. So it's the way business is done, unfortunately, because consumers are not knowledgeable about it. But we quote loans with points because our competitors quote loans with points. That's true. That's why. Because everyone else is doing it. That's why. It's because everybody else is doing it. And you, as a consumer, aren't smart enough to look behind the curtain to realize that's what they're doing to you. So I hope with this video today, I've reiterated to you the importance of doing the math when it comes to upfront costs on a loan. I've done a video, which I'll link in the description below, to guide you as a consumer if you're looking to find out what interest rates really are. I give you some tips on how you can kind of search around and get to that information online, and beyond all the fluff and the misleading stuff that's out there. So I'll link that below. I'm also available to answer any questions. If you have, leave them in the comments below. My recommendation for any consumer looking to get a mortgage, period, whether it's a purchase or a refinance, is to work with an independent mortgage broker in their local area, someone who is experienced, someone who has not a big team or a big office. This person is going to be able to offer you the best interest rates out there without the high margins, without the high overhead built into it. So you as a consumer will be able to get the best deal that's out there. That's who I am. And if you had any questions, please leave a comment below or follow me on my website, lifeandloans.com. Thank you for watching the video today. Hope everyone has a great day.